All right, let's get right into it. Welcome to today's explainer on MercadoLibre. We're unpacking a really fascinating corporate narrative that just recently unfolded in the world of Latin American e-commerce and fintech. We're going to break down their Q2 2026 earnings report, dig into the massive strategic bets they're placing, and look at the intense valuation debate happening on Wall Street right now. Now, to be clear, we aren't here to pick a side on the stock price or give financial advice. Instead, our goal is to use the data to give you a crystal clear understanding of exactly what's happening under the hood of this digital giant.
Okay, let's dive into this. Here's our roadmap. We'll cover the King of LATAM, record revenue, shrinking profits, following the money, the Mexican expansion, fending off the competition, and finally, the Wall Street debate.
Section 1. The King of LATAM, a digital giant. To really ground ourselves in the sheer scale we're talking about here, consider this number, 120 million. Since 1999, MercadoLibre has expanded across 18 countries to reach 120 million unique active buyers, supported by over 1 million active sellers. I mean, this isn't just a regional player anymore. It's a gravitational force shaping Latin America's entire digital economy. But here's the thing, it's not just about e-commerce. And this brilliantly illustrates the real secret weapon of their business model. They call it the ecosystemic user. This happens when a customer doesn't just buy things on MercadoLibre, but they also use the company's fintech and payments arm, Mercado Pago. When these two services overlap, the results are honestly staggering. These integrated users generate 70% more gross merchandise volume and nearly 90% more payment volume than a user on just one platform. It is an incredibly powerful flywheel effect that ties the marketplace, logistics, and credit together seamlessly. Moving right along to Section 2, revenue, record shrinking profits, the Q2 paradox. So on August 5th, 2026, MercadoLibre dropped a Q2 earnings report that presented a fascinating paradox for us to look at. On one hand, you've got explosive growth. Quarterly revenue crossed the $10 billion mark for the very first time, hitting $10.17 billion. That's a massive 50% year-over-year increase, marking their fastest top-line growth in 4 years. Earnings per share beat expectations, and total payment volumes surged to $101 billion. Incredible, right? But here's the challenge. The operating margin compressed by 550 basis points, dropping down to just 6.7%, which caused net income to actually fall 11% to $466 million. Naturally, the market reacted instantly to this margin squeeze, and the stock dipped 3% in after-hours trading. So you've got to ask, was this a failure in cost control? Well, according to management, absolutely not. CFO Martin de los Santos made it abundantly clear that this was a deliberate strategic choice. They're intentionally sacrificing short-term profitability to prioritize long-term growth and value creation. They view these margin compressions not as a leak in the ship, but as fuel being purposely diverted right into the engine. Which brings us to Section 3, following the money. 3 major bets. If they're deliberately spending that profit margin, we need to follow the money to see exactly where those dollars are going. It basically boils down to 3 areas. First, they poured $441 million into capital expenditures for logistics and infrastructure in Q2 alone to expand their Mercado Envíos fulfillment network. Second, they deployed an enormous $2.1 billion into expanding their credit portfolio. And third, they are investing heavily in artificial intelligence, rolling out AI-powered search experiences built on large language models to improve product relevance and conversion rates in their key market. Let's look a little closer at that second bet, credit. Their total credit portfolio has now reached an incredible $16.4 billion. That is up 75% year over year. They issued 2.6 million new credit cards in this quarter alone. But what's truly impressive here is that despite this rapid, aggressive lending growth, their non-performing loans are sitting at historic lows of just 7.0% for the total portfolio. And regarding their third bet on AI, company executive Leandro Cuccioli summarized it perfectly. He said, AI is the backbone of our growth strategy and is already embedded in everything we do, from personalizing the user journey to the complex models that analyze thousands of variables in milliseconds. You see, they aren't just using AI for customer search. They've actually deployed AI assistants to roughly 31,000 of their own employees. The result? Code submissions have skyrocketed 90% year over year, making their internal teams vastly more productive. Section 4. The Mexican expansion, a $4.6 billion bet. Now, to understand their geographic strategy, we have to look at the sheer scale of their commitment announced in June 2026. A $4.6 billion investment specifically earmarked for Mexico. That is a 35% increase from what they spent there last year. This capital is being laser-focused on logistics, tech, and financial services, and it's expected to create 8,500 new jobs. Over the past 6 years, this brings their total cumulative investment in Mexico to a staggering $14 billion. They are going all in. But this massive investment isn't exactly operating in a vacuum, right? It's fighting against some very real-world friction. Down in Mexico, MercadoLibre's gross merchandise volume growth has actually decelerated recently. They're facing severe headwinds from local tax reforms and just a generally weaker macroeconomic environment. On top of that, higher device costs and one-off inventory restocking pressures are actively squeezing their margins in the acquiring business, so they're having to spend big to push through these barriers. Section 5. Fending off the competition. The battle for Brazil. So while they're expanding in Mexico, they're also playing heavy defense elsewhere. According to analysis from Bank of America, MercadoLibre is facing major threats from competitors who are larger, highly diversified, and possess a massive capacity for consumer engagement. Specifically, they're going head-to-head with Shopee, TikTok Shop, and a rising tide of broader cross-border e-commerce platforms who are all looking to take a slice of the LatAm pie. So how are they defending their turf? Tactically and very aggressively. They've maintained over a 50% consumer preference in key Brazilian states like São Paulo and Rio de Janeiro, successfully outperforming Shopee in Q2. But to do this, they intentionally took a hit to their own revenue. They cut commissions in certain categories and lowered their free shipping thresholds. And you know what? It's working. As a direct result of these margin-cutting tactics, items per buyer grew 19% year over year. Basically, they are trading margin today for market share tomorrow. Finally, Section 6. The Wall Street debate, impartial valuations. This delicate balancing act of high growth, heavy investment, and margin compression brings us right into the valuation debate. First, it's absolutely crucial to understand who actually owns this company. An overwhelming 87.62% of outstanding shares are held by institutional investors. Despite the margin concerns we've talked about, big money is doubling down. In Q2 alone, BlackRock acquired a branding position valued at $2.25 billion, giving them over a 2.6% stake in the company. Capital Research Global Investors also boosted their position by 22.5%. The institutions clearly see a long-term play here. But the valuation models themselves are completely split. On one side, you have the bull case. Analysts using discounted cash flow models look at the massive revenue growth and estimate a fair value of around $7,300 per share. That would mean the stock is over 70% undervalued. But on the flip side, in the bear case, folks focusing on earnings multiples point out that MercadoLibre is trading at nearly 50 times earnings. That is well above the global multi-line retail industry average of just 20 times. Currently, analyst consensus sits right in the middle, with a moderate buy target of $2,272. It is a classic battle of cash flow optimists versus earnings multiple pessimists. Which leaves us with this final, pivotal question for you to think about. Will MercadoLibre's ecosystem flywheel bet ultimately deliver both explosive growth and long-term profitability? Management is clearly convinced that their disciplined investments in logistics, AI, and credit will pay off, turning those compressed margins back into massive profits down the road. But whether that calculated risk actually pays off in the long run is something only time will tell. Thank you so much for joining me to unpack this explainer today. Keep learning, and I'll catch you next time.